What's up guys, welcome to door number 21 of the finance calendar, where we dive into 24 financial ratios in 24 days. Don't forget to subscribe so you don't miss any of the ratios, and let's go! Today we are going to talk about the net working capital. It tells us how liquid the company is and how well the company is able to fund its operations and meet the short-term obligations. It is calculated by subtracting current liabilities from current assets. Let's take a look at a quick example. You can find all the required information from the company's balance sheet. Intel's latest report's current assets are $61.3 billion. The current liabilities are $29.6 billion, which means that the Intel's net working capital is $31.7 billion. So, what is the use of the net working capital? If the result is positive, it means that the company has more assets than liabilities, which means that the company is able to fund its operations and has the possibility to invest and grow in the future. If the company has a negative net working capital, it means that the company has more liabilities than assets, which might mean that they have trouble paying the short-term obligations. You can again use the net working capital to compare different companies in a similar industry, but higher isn't always the better. A very high net working capital ratio could mean that the company is not using its cash efficiently. Instead of investing it for future growth, the company might have excess cash, which makes the net working capital ratio higher. Always use all the available information and ratios when making investment decisions. That's it for today's financial ratio. Hit the like button if you found this video helpful and subscribe so you don't miss the future ratios. Have a great day and I'll see you tomorrow. Bye!